Hi, this is Roger Nussbaum. Welcome to the Big Picture for the week of November 19th, aka Thanksgiving week, so hope everyone has a happy holiday. A couple things to go over this week, actually a few things. Some questions. What is the answer to the question about appropriate returns was one. A quote that someone left from Rev Shark, he writes for realmoney.com. Someone left a comment about derivatives, a little funny tidbit about CNBC's new website, and then kind of a state of the blogosphere type of comment. So first, what is the answer to appropriate returns? I did a post earlier in the week that kind of explored the issue, and a reader left a comment asking about the question. And I guess just to reiterate or underscore the whole point of the conversation is there is no really appropriate answer that fits for everybody. There has to be, and part of what I was getting to is a sense of game over when it's appropriate in your portfolio. If you've got $6 million and you know you're only going to need $35,000 a year, well, you need to think about some sort of sense of game over to protect what you have, or if you're inclined to want to, give money away or whatever. But that person really needs very little growth. If you've got $700,000 and you circumstantially know you're going to need $75,000 a year, well, you got to invest fairly aggressively. Your plan, and that's kind of the key point, is the plan has to accurately reflect your financial plan, what your account needs to do. And again, I brought this up before. This is not a pitch to hire us. I'm sure our plans that we do for people are very special, but in all seriousness, you just need something, and it could be as simple as a spreadsheet, although I would do a little more than that, but just kind of projecting out under a couple of different scenarios, above average growth, below average growth, just sort of plan out what you're doing, how it will work for you over whatever time period that you're talking about. If you've got 20 years to go before you start drawing income, or 30 or some other number, and look at it that way and really spend the time, could be very important for you going forward. Next issue, someone left a comment by Rev Shark, who again writes for TheStreet.com. The point was, a lot of people, including me, are wondering if or when, and more like when, the market is going to roll over. This is all an assumption that stock market cycles have not been repealed. I've mentioned a couple of times, and with an assist to Barry, that this is the second time in history that the stock market has gone 900 days without a 10% correction. That, to me, is pretty serious stuff. Doesn't mean Armageddon's coming, far from it. I've never been an Armageddon camp person, just a normal correction. And there's a great quote in his post. Rev Shark writes, "What will you do if the ball is hit to you?" Kind of what a coach would say to a Little League ball player. Know what you're going to do if the ball comes to you before it comes to you, and this is kind of the same thing with your portfolio. Know what you're going to do with your portfolio before you need to do it. Having a plan of action, and then and this is something that's been a recurring theme here ever since I started the blog, having some sort of plan of action and that you have a foundation or a basis to believe will work, and then having the discipline to stick to it, and that's probably the more important thing, is sticking to it, is crucial. It doesn't matter what it is, doesn't matter if you get it wrong a couple of times. The whole point here from where I'm coming from is trying to miss a big chunk of a massive decline. Lagging a little bit here and there is one thing. Trying to sidestep, the next 30% decline, and here I'm talking about a chunk of it, not the whole thing. Pretty important for your long-term health, if you will, of your portfolio. And I think this is just a fantastic quote and something to think about. What are you going to do when the ball gets hit to you? It's a great way to phrase it. Someone left a comment that I think I misunderstood about derivatives. About having some portion in derivatives, and I think I took the implication to be more aggressive than what the person intended. So I'm going to backtrack on that and talk a little bit about, some of these products are so complex, there's no I'm going to tie it up here in 90 seconds, but some of these structured products can play a role for people. There was just a Business Week article on them. There's a bunch of them that exist that you can look at quantumonline.com for details on them. A lot of them are very complicated. A lot of them, when they first list, are very expensive. But if you wait 6 months or a year after they list, so here I'm saying you can look at ones that listed a year ago to find this effect, You find some that are below their $10 price, which is what a lot of them price at, and the price that a lot of them guarantee you a minimum return to. It can be a way, but you've got to spend a lot of time with the prospectus, or even call the firm and ask them about them, because they can be extraordinarily complicated and not what they seem. But the ones that are what they seem can play a role as a way of softening or dampening volatility. If you can buy something at $9.50 that you know is going to give you $10 in 2 years, at worst case scenario, well, there's something to be said for that. It's not great returns, but if you are wildly bullish on the market and that turns out to be 180 degrees wrong, something like this can be a way to spare you some pain. The covered call funds, or the call writing funds, I guess more appropriately, those are vehicles that use derivatives. There's plenty of other products out there that one way or another use derivatives. And so if the person who left this comment was talking in that light, well, then yeah, I would agree it is something to be explored. There's some interesting things that can be done, or you can have done for you, that do lower volatility, which for some people is right, not everybody, but for some people is the right thing. A couple of funny things. I got an email, like a press release from maybe a PR firm about CNBC's new website, and it was a long list of all the great hires of people that are going to be associated with the site. Well, what was funny is it wasn't who's going to be providing content to the site. It's things like producers or content aggregators, people that do kind of the running of the website. Nothing about any of the information that's going to actually be on the site. Well, here's hoping that they do a good job with the site. For all the fanfare and all the integration we're likely to see in their programming, I really do hope it's useful. I like to make fun of CNBC because it's easy to do, but the fact is a lot of people watch them. There is information to be gleaned, and hopefully there's value to be added from this website. I hope that that's the case, and we'll just see what happens. One last thing, it'd be a kind of a comment on the state of the blogosphere. I know Adam over at Daily Options hates that word, and sorry about that, but Ugly over at Ugly Charts left, that's a pretty good blog for you to check out if you don't know it, by the way, left a kind of a top 10 list of why I read your blog, and he listed 10 down through 1. One of the, I think number 4, was everyone reads your site, and he included my site as one of them. Well, I don't get that much traffic, actually. My site meter is public information. If you look on there, there's somewhere around 11 or 1,200 people that visit the blog. It's possible with where my stuff gets picked up or aggregated to that I reach a few more people than that. But the point is that despite all of the, thankfully, positive attention the site has gotten, I get 11 or 1,200 hits a day, which is almost nothing. And so the point that I want to try and make with that is that the blogosphere is still pretty early on in its development. And this is kind of important. I've been saying from the start that this has the potential to evolve into something that is perpetually more useful to more people. And I hope that continues to be the case. Take this as a cue. If you work in the business and have something to say, start a blog. It's easy to do. There's no barrier to entry. If you are a do-it-yourselfer and you've got something to say, same thing, start a blog. There are plenty of blogs out there written by people that are doing it themselves, that have useful things to say, and there are people in the business that write that really don't have a lot that's useful to say. It's kind of open to all comers. I've said this before, people will vote with their clicks. Other than that, have a good weekend. Arizona Sun Dogs, how about that? Enjoy the Michigan-Ohio State football game.